Picture this. It's 1999 and someone just paid $7.5 million for the domain name business.com. $7.5 million for a website address. That hadn't even been built yet. At the same time, a company called Pets.com was spending $2.2 million on a single Super Bowl commercial to sell dog food online. Their annual revenue, $619,000. They spent 4 times their entire yearly income on 30 seconds of TV time. And somehow investors were throwing money at these companies like they discovered the secret to printing cash. This is the story of the dot-com bubble, when the entire world went temporarily insane about the internet, burned through $5 trillion in 6 months, and learned some very expensive lessons about what happens when you forget that businesses actually need to make money. Spoiler alert, they crashed. Hard. But how we got there is a masterclass in human greed, technological promise, and the fine art of believing your own hype. To understand how smart people convinced themselves that selling dog food online was worth billions, we need to go back to 1995. The internet had just become a thing normal people could use. Before this, it was mostly universities and government researchers sharing files. But now, regular folks could point-click and suddenly access information from anywhere in the world. Entrepreneurs looked at this and saw dollar signs everywhere. If people were spending hours browsing websites, surely there was money to be made. The problem was nobody really knew how, but that didn't stop them from trying everything. Online bookstores, digital pet supplies, grocery delivery, websites that sold nothing but advertising space. If you could stick .com at the end of it, someone was building a business around it. The early pioneers actually made sense. Amazon started selling books online in 1995 because books were perfect for internet commerce, standardized products easy to ship, and people knew exactly what they were buying. eBay launched in 1995 as an online auction house connecting buyers and sellers who'd never meet in person. These companies proved the internet could work for business. They were making real money from real customers buying real things. But here's where things get interesting. Wall Street noticed. In August 1995, a little company called Netscape went public. Netscape made web browsers the software people used to browse the internet. They were important, but they were still just a software company. Their stock was supposed to open at $14 per share. By the end of the first day, it closed at $58. The company was suddenly worth $2.9 billion. For context, Netscape's annual revenue was $85 million. Wall Street had just valued them at 34 times their yearly income. For a normal company, that would be insane. For an internet company in 1995, it was apparently reasonable. This caught everyone's attention. Investors who'd missed out on Netscape started looking for the next big internet thing. And entrepreneurs realized they didn't need profitable businesses, they just needed internet businesses. The venture capital money started flowing. In 1995, VCs invested $4 billion in startups. By 1999, that number hit $54 billion. That's a 1,250% increase in 4 years. But here's the thing about easy money, it makes people do stupid things. Normal businesses are valued based on profits. How much money do they make after paying all their expenses? Simple math. But internet companies in the late 90s had a problem. Most of them weren't making profits. In fact, most of them were losing spectacular amounts of money. So, Wall Street invented new metrics. Instead of profits, they looked at eyeballs, how many people visited the website. Instead of revenue, they tracked page views, how many times people clicked around the site. The logic went like this: if millions of people are using your website, you'll eventually figure out how to make money from them. Growth first, profits later. This created some truly bizarre valuations. TheGlobe.com, a social networking site, went public in November 1998. The stock jumped 606% on the first day. The company was losing money and had no clear path to profitability, but they had users, so apparently that was enough. Priceline.com let people bid on airline tickets. They went public in March 1999 and reached a market cap of $23 billion. Their annual revenue was $35 million. That's a price-to-sales ratio of 657. For comparison, Walmart's price-to-sales ratio today is about 0.8. And then there was Pets.com. Pets.com launched in August 1998 with a simple idea: sell pet supplies online and deliver them to your door. Convenient, sure. Profitable. That was apparently optional. The company raised $82.5 million from investors who believed that pet owners would pay premium prices for the convenience of home delivery. They spent $27 million on marketing in their first year, including that famous $2.2 million Super Bowl ad featuring a sock puppet dog. Let's do the math here. Pets.com's average order was $32. But shipping costs, customer acquisition, and overhead meant they lost money on every single sale. They were literally paying customers to take their products. But this didn't matter to investors. The pet supply market was worth $23 billion annually. If Pets.com could capture just 1% of that market, they'd be worth hundreds of millions. The plan was to lose money until they got big enough to negotiate better deals with suppliers and shipping companies. This strategy had a name: get big fast. Worry about profits later, just grow as quickly as possible, and dominate your market before competitors could catch up. It worked great, right up until it didn't. While Pets.com was busy losing money on dog food, other companies were taking the internet changes everything mentality to even greater extremes. Cosmo.com promised to deliver anything: snacks, movies, books, beer to your door within 1 hour. In Manhattan. For free. No minimum order. Think about this for a second. You could order a single candy bar and Cosmo would pay someone to bike across the city to bring it to you. For free. They were essentially running an urban delivery service at a massive loss and calling it a tech company. Webvan took grocery delivery to the logical extreme. They raised $396 million to build automated warehouses in 26 cities, promising to deliver fresh groceries within 30 minutes of your order. The problem was, groceries have thin profit margins even when customers pick them up themselves. Add in the cost of warehouses, delivery trucks, and drivers, and Webvan was losing $130 on every order. But they had a plan to make it up in volume, which is possibly the worst business strategy ever invented. Then there was Flooz.com, which created its own digital currency for online shopping. You could buy Flooz credits with real money, then spend them at partner websites. It was like Bitcoin, except worthless and backed by nothing. All of these companies had one thing in common: they were solving problems that didn't really exist, or they were solving real problems in ways that were guaranteed to lose money. But investors kept funding them because the internet was the future, and nobody wanted to miss out. By March 2000, the madness had reached peak absurdity. The Nasdaq index, heavy with tech stocks, hit 5,048 points. It had more than doubled in just 15 months. Companies were going public without ever making a profit. Some were going public without ever making revenue. Pets.com went public in February 2009, months after launching, and while still losing millions every quarter. Day trading became a national obsession. People quit their jobs to trade internet stocks from home. CNBC became appointment television. Everyone had a stock tip, and every tip seemed to work. The phrase "new economy" entered common usage. Traditional businesses that dealt with physical products were old economy. Internet businesses that dealt with pure information were new economy, and apparently the old rules didn't apply to them. Alan Greenspan, the Federal Reserve Chairman, warned about irrational exuberance in the stock market as early as 1996. But by 2000, even he seemed to believe that maybe this time really was different. It wasn't. The crash started slowly, then happened all at once. In March 2000, Barron's published an article titled "Burning Up" that analyzed 51 major internet companies. They calculated how long each company could survive at their current burn rate, how fast they were spending cash. The results were sobering. Most companies had less than 12 months of cash left. Some had less than 6. And the public markets? which had been happy to fund losses indefinitely, were starting to ask uncomfortable questions about when these companies might actually turn a profit. The Nasdaq peaked on March 10, 2000, then started falling. Slowly at first, a few percentage points here and there, then faster. By April, venture capital funding started drying up. Companies that had been counting on raising more money to fund their operations suddenly found themselves unable to get meetings with investors. The reality of business fundamentals came crashing back. Revenue mattered. Profits mattered. Having a sustainable business model mattered. All the things that had been dismissed as old economy thinking turned out to be pretty important after all. Between March 2000 and October 2002, the Nasdaq fell 78%. $5 trillion in market value simply vanished. Pets.com, the poster child of dot-com excess, shut down in November 2000, 9 months after going public. They sold their remaining inventory at liquidation prices and returned whatever cash was left to shareholders. The sock puppet dog mascot was more valuable than the actual business. Cosmo burned through $280 million before shutting down in April 2001. Webvan spent $1.2 billion and closed in July 2001. Flues.com collapsed when it turned out criminals were using stolen credit cards to buy Flues credits, then converting them back to real money through partner sites. The human cost was enormous. Silicon Valley unemployment hit 8.5%. Over 200,000 tech workers lost their jobs. Retirement accounts evaporated. The companies that survived Amazon, eBay, Google saw their stock prices fall 80 to 90% from their peaks. But here's the ironic twist. The internet really was revolutionary. Just not in the way most of these companies thought. The survivors learned to focus on sustainable business models. Amazon stopped trying to sell everything to everyone and focused on becoming the most efficient retailer on earth. Google figured out how to make searching the internet incredibly profitable through advertising. eBay refined their marketplace model until it was genuinely useful for millions of buyers and sellers. Today, the internet economy is worth trillions of dollars. Online shopping, digital advertising, cloud computing, social media, all the things .com companies were trying to build in 1999 eventually became massive, profitable industries. The difference is that the companies that succeeded understood something the .com bubble forgot. Technology doesn't eliminate the need for sound business fundamentals. It just changes how you apply them. Pets.com was right that people would buy pet supplies online. They were just wrong about everything else: pricing, logistics, customer acquisition costs, and basic math. So the next time someone tells you that this time is different and traditional business rules don't apply, remember the sock puppet dog and the $7.5 million domain name. Sometimes the most expensive education is the one that teaches you the oldest lessons. And the craziest part, we're probably going to do it all again with the next revolutionary technology. Because apparently that's just how humans work.